Hey guys, Sean Pruitt here, president of Kingdom Exploration. OPEC just recently released a report yesterday saying that we're going to see an increase in demand by 2.33 million barrels of oil a day. And they made some minor adjustments simply because there is expected better demand for China oil demand. Now, here's the deal. Where is this extra oil production going to come from? Now, we've been in a oversupplied market simply because Russia is supplying more oil to the market than expected. We've got China demand increasing much slower than expected. We also have the fact that the first quarter of the year is a reduction in demand simply because refineries are not buying near as much oil because a lot of them are going under maintenance. Now we're shifting into the summer months. We got summer driving season. We've got the OPEC cut that they announced in April kicking in. And that's going to reduce the amount of oil out to the markets. And there's many analysts and many market traders that are saying that the recession fears were way overblown and the banking crisis were overblown. Okay. And so all of that, and because of the job numbers, which looked very good, is causing all those recession fears to go out the window. So now we are going to be going into an undersupplied market in the summer months, second and third quarter. We expect to, SPR is expected to start refilling. Okay, so where's that oil going to come from? So here's the deal. Many analysts were not expecting to see a demand at the end of this year. And OPEC is saying, look, guys, the demand for oil is increasing. Many analysts were banking on the fact that we're going into recession. Well, those recession fears are falling. Okay. And so what's going to happen in the summertime when we go into the driving months and we're in an undersupplied market? We're going to see oil prices climb substantially. I don't know if we're going to be 100 plus, but I'm very confident we're going to see 90 plus in the coming months. Okay. Now, what many people are expecting, they're expecting shale oil and gas, U.S. oil and gas to increase their output. Now, we peaked in 2019, and Scott Sheffield a couple of days ago, who is the CEO of Pioneer Natural Resources, one of the biggest producers of U.S. shale oil and gas, is saying we will never reach peak output as the days of 2019 for multiple reasons. He blames it on refinery limitations, supply chain issues, inventory issues. And but the thing is, what most shale producers are not admitting to is the fact that, listen, shale oil and gas is the most expensive barrel of oil, and it's the fastest declining formation. For instance, a conventional well in Saudi Arabia and Russia and America, the decline is 10% a year, as where a shale oil well is 4.5 times faster decline. So if you're producing 1 million barrels of oil a day, by the end of the year, it's going to reduce by 450,000 barrels of oil. That means you have to increase output, drill new wells to increase output of 450,000 barrels of oil just to maintain 1 million barrel a day output. Okay. And so right now we're producing about 12 million barrels a day. Do the math. Okay. So how in the world does the EIA expect to see an increase output of U.S. oil when the ESG is putting pressure? So for instance, under pressure from ESG trends and shareholders, some banks have announced recent months tougher rules on the financing of fossil fuels. France's top bank, BNP Paribas, to stop funding new oil and gas field. They're just one of many banks that have gone woke that are falling to the pressure of ESG to stop funding oil and gas. Under a pro-oil and gas administration, we were able to reach a peak high of 13.2 million barrel a day output. What do you think is going to happen with ESG pressures, all these banks going woke, an anti-oil regime in office, these rules coming down preventing, you might have a 401k or accounts that you don't even realize that are not investing in oil and gas because you don't have any control on it because it was mandated by the U.S. government to control where your money goes. You have to literally pull it out, put it in like a self-directed IRA just to be able to invest in oil and gas or whatever sector you want to invest in. Okay. It's nuts. Okay. So where is this excess oil going to come from if world oil demand is increasing by 2.33 million barrels of oil a day? Now, here's the thing. The economy in America is looking better than we expected. We're going in the summer driving months. We have a lot of geopolitical things that are going on that could greatly reduce the supply. Okay. But we're not taking that into account simply because this recession fear and the banking crisis was overplayed. Well, that's all going away. So now when something new happens with Iran or Russia or what have you, you're going to see a tick up in oil prices as the markets become tighter. Okay. OPEC is in the driver's seat, with shale out of the way. In the past, they were very patient, waiting for shale to decline. So they allowed oil prices to average around $50-something a barrel under Trump because we were in a shale oil glut. If OPEC was to decrease output, that would just put more money in shale's hands to spend more money on oil and gas development. Now, shale oil is capital discipline right now. They're trying to do stock buybacks, and they're trying to give more dividends back to shareholders. Okay. But ultimately, they're not developing because it's not near as profitable as it used to be. And it's harder to get the financing that they need. Okay. And so OPEC knows this. OPEC doesn't have to compete with shale oil and gas anymore. So now they're in the driver's seat. They can curb production. And yes, the shale industry is going to make more money, but it's not going to increase the amount of shale oil and gas development. Okay. And so OPEC is in the driver's seat now. And so in the event that oil demand decreases, in the event that America has a recession, OPEC simply curbs output and oil prices will strengthen. We couldn't have done that during the shale glut. We couldn't have done that during many times when oil prices dropped. For the first time, we had plenty of time to prepare for this. OPEC has been very good about, because in the past, 2008, 2009, so oil demand dropped 2 times in world history. One time during the financial crisis, 2008, 2009, oil prices dropped down to $40-something a barrel, but climbed back up to $130 a barrel. OPEC said, listen, if we knew what we knew now then, and I'm not talking about just if they had a crystal ball and they knew exactly what was going to happen. They're just more intelligent. They could see, they could be better prepared. They would have curbed production before that happened. They would have saw the writing on the wall. And so the everything that Jerome Powell and the federal interest rate hikes were happening, they were reducing oil output at the right time. And so oil prices never declined and never crashed. In the past, oil prices might have dropped down to $50, $60 a barrel, but they didn't. Okay. So we're at the worst of the oil price slide. We had a 3-week decline. And so now we're going to start seeing oil prices come back strong. Okay. And so OPEC is in the driver's seat. They're in control. At the end of the day, it doesn't matter what happens to the markets. They could cause the market to be oversupplied. They could also cause the market to be undersupplied because they have enough. They're in very good position to be able to do that. Okay, so I'm very. There's many analysts that are in the camp of they are bullish on oil, and the longer we stay in this position with the recession fears overblown, the oil prices are going to be it's going to be a knee-jerk reaction simply because we're going to see an undersupplied market because people don't get it. Analysts are sounding the alarm bells, but people are not hearing it because they're so blinded by recession fear and everything else. Well, all of that is falling by the wayside. So we're going to have a different market next week for oil. If you are an oil and gas investor, this would be a good time to take advantage of the stock prices. I'm not a stock guy. I'm an oil guy. You know, I'm like Robert Kiyosaki in that. I don't like to buy paper. I like to buy oil. Okay. And so if you guys are interested in learning more about that, go in my description below and click on the link. Bottom line, I truly believe that we and many analysts agree that we're going to be in an undersupplied market sometime this summer, maybe the end of summer, and we're going to see oil prices come up substantially. I don't think shale is going to come close to what they think they can do. And I think it's going to be even a worse situation. But here's the thing. If Shell doesn't come to the rescue, OPEC might increase their oil output. So I don't see the oil prices spiking to $130 a barrel in the event that something major happens. And I don't see oil prices crashing to $60 a barrel in the event that something crazy happens, because OPEC is going to balance the markets. OPEC, all of these countries, they need $80+ of oil to balance their country. They were bleeding out during the days of Donald Trump, during the Shell oil glut. They were bleeding out during the days of COVID. It's time for them to capitalize. It's time for them to make money. They're tired of not making the kind of capital, the kind of profits that they made in the days of 2008 and 2010, 11, and what have you. All right, guys, I'm Sean Pruitt, president of Kingdom Exploration. If you like this channel, please subscribe, and we'll talk soon. Thanks.